Okay, let's get started. Today, we're doing a deep dive into the Q2 results for fiscal year 2026 for Berger Paints India Limited, well, BPIL. We looked at the investor presentation, the financials, and listened to the earnings call from November 4th. And it paints a really interesting picture, doesn't it? A story of defense almost.
It really does. You've got these two major pressures hitting them at the same time. First, this incredibly bad monsoon season just hammering their key markets. And second, the competition is still fierce, forcing them to keep spending, maybe even increase spending.
Right. So our goal here is to kind of unpack the strategy behind those headline numbers. Why did they seem to, well, let margins slide a bit in the short term? It looks like a deliberate move to protect their market share.
Precisely. And you see that tension immediately in the core numbers. There's this paradox right at the start.
Yeah, that's what caught my eye too. Looking at their standalone performance for Q2, volume growth, so the actual amount of paint sold, was up 8.8%. That sounds pretty healthy, high single digits.
Yeah. It does suggest demand is there, or at least they're getting the product out effectively. But then you look at the value growth from those same sales.
It's just 1.1%. Barely moved. How does that happen? Selling almost 9% more stuff, but making only 1% more money. That huge gap, that's really the core of the Q2 story.
Absolutely. And the first, most obvious reason is the weather. The monsoons this year were apparently unusually long and heavy, hitting some of their biggest markets hard.
We're talking Andhra Pradesh, Kerala, West Bengal, Gujarat, Maharashtra, all key areas for decorative paint sales.
Yeah, and it's simple logic, really. As management said, if it's raining nonstop, nobody's painting the outside of their house or undertaking big projects.
So that caps the value growth straight away, but it also messes with the product mix, which seems to be the main driver of that big volume value gap.
It is. There's a bit of an effect from price cuts they took last year in FY24. But the big factor this quarter was definitely that adverse product mix.
Let's quickly define a term here that's important. ASP, or average selling price.
Right. It's just the average price they get for each unit, like a liter or a kilogram of what they sell. And when the weather turns bad, like this.
The high-value, high-ASP products just stop selling.
Exactly. Your premium exterior emulsions, those fancy antifungal paints, special roof coatings, they generally have higher margins, cost more per liter.
And you just can't apply them properly when it's pouring down.
Precisely. So those sales dry up. And this is where it gets, as you said, really interesting. You start seeing a bit of down trading.
Meaning people shift to cheaper options.
Marginally, yes. The data suggests a slight shift away from the premium and luxury paints towards the more basic economy emulsions, both for interiors and exteriors. Maybe people are just doing essential touch-ups instead of full repaints when the weather's so uncertain.
So fewer sales of the profitable high ASP stuff and proportionally more sales of the lower ASP products.
That's it. Things like construction chemicals, tile adhesives, basic putty. These things still sell because general construction activity continues or people do small interior jobs. They help keep that volume number up near 9%.
But because they sell for less per unit, they pulled the overall value growth way down to that 1.1%.
Exactly. Selling more units, but cheaper units on average. It's worth mentioning, though, some segments did okay.
Right. They mentioned construction chemicals and wood coatings actually saw robust or good growth. That must have helped a bit.
It did provide some buffer, and the industrial side wasn't as badly affected either. Auto and powder coatings apparently delivered mid-single-digit growth in both volume and value. They're less tied to the decorative market's weather woes.
Okay. But overall, the main profit measure still took quite a knock.
Yeah, let's pivot to that. The standalone PBDIT margin, that's profit before depreciation, interest, and tax, basically a measure of operating cash flow. You can think of it like EBITDA.
It moderated quite sharply, fell from 15.8% in Q2 last year.
Down to 12.7% this Q2. That's nearly a 19% drop in the margin rate year on year. Significant.
And this wasn't just bad luck, was it? It seems linked to those strategic spending decisions you mentioned.
Correct. Two main things driving that margin drop. First, lower operating leverage, sometimes called the scale effect.
Can you quickly explain that scale effect?
Sure. Operating leverage is basically about how efficiently you cover your fixed costs, things like factory rent, salaries, basic utilities as your sales go up or down. If your sales value barely grows, like that 1.1%.
You can't spread those fixed costs over many more rupees of revenue, so each rupee of revenue has to carry a bigger slice of the fixed cost pie.
You got it. That makes your margin shrink. It's harder to absorb the costs when value growth is flat.
Makes sense. And the second factor, you said it was deliberate spending.
Yes, They consciously chose to increase spending on brand building and other investments, even while revenue was struggling. They didn't cut back.
How much increase are we talking?
Advertising and promotion, A&P, spends were up 22 to 23% compared to the same quarter last year. That's a big jump.
Wow. Why do that when sales are tough? Management called it a forced choice.
They did. They acknowledged the timing wasn't ideal. Advertising paid heavily during relentless rain probably doesn't give you the best immediate return, the best bang for the buck.
Seems counterintuitive. If the project market in cities is stalled by rain, why pump money into ads then? Why not wait until September or October when things picked up?
Well, their argument is about the competition, especially with the new entrant spending aggressively. If BPIL pulls back on advertising, they lose visibility, they lose share of voice. Regaining that later can be even more expensive than just maintaining the spend.
So it's defensive spending, partly.
Partly defensive, yes, but potentially also corrective. They specifically mentioned continuing investment in manpower, particularly in what they called weak urban markets in the West and South. These have historically been areas where perhaps they weren't as strong as some rivals.
So it might be about fixing a longer-term strategic weakness, not just reacting to the present.
Could be. They need feet on the ground in those cities. And this off-roll manpower they mentioned.
Which is basically contract or third-party sales stuff.
Right. Crucial for pushing sales and managing dealers, especially in those project-focused urban centers. They kept paying for these resources, booking it under other expenses, even when the rain meant those teams couldn't fully execute on projects.
And you see the impact on the financials. Other expenses rose from about 17.8% of income last year to 19.5% this quarter. Employee costs also ticked up from 6.8 to 7.4%.
That's the cost of the strategy right there. Higher fixed and semi-fixed costs hitting the P&L during a period of very low revenue growth. It's the price they paid to hold their ground.
Okay, let's talk about that competitive ground. How is the broader landscape looking?
Management said competitive intensity has, quote, stabilized, but it's still high.
Stabilized?
Yeah.
What does that actually mean in practice? Does it mean the crazy discounting has eased off a bit?
That seems to be the implication. Based on their checks with dealers and market feedback, they suggested the really aggressive, perhaps unsustainable launch tactics from the new entrant might be moderating, maybe settling into a more normal, though still intense, competitive rhythm.
And they actually estimated the new player's Q2 sales were lower than Q1. How do they figure that?
Again, it comes down to those channel checks, talking to their network. It suggests the initial disruption might be finding its level. It doesn't mean the pressure is off, but maybe it's becoming more predictable. BPIL feels their sustained brand spending can start to have a clearer impact now.
Interesting. So given all this, the rain ending, the competitive scene stabilizing a bit, what's the outlook for the next couple of quarters?
They're sounding pretty optimistic, actually. They're banking on significant pent-up demand being released now that the weather's better, especially after the Diwali season.
So demand picks up. What does that do for margins?
Two positive things should help there. First, raw material prices are apparently quite benign right now. That alone could give them maybe 1 to 1.5% of gross margin expansion just from lower input costs.
Okay, that's helpful. What's the second thing?
It's the reversal of that product mix issue. As exterior painting and bigger projects restart, those higher value, higher ASP products should come back strongly. That naturally lifts the average selling price and boosts the overall margin profile.
So despite the weak Q2, they're sticking to their previous guidance.
Pretty much. They expect mid-single-digit value growth in Q3 and then accelerating closer to double digits in Q4. And crucially, they aim to get back into that 15 to 17% operating profit margin band.
Hopefully towards the higher end by Q4, they said.
Yes, that's the target. Oh, and one quick bookkeeping point. There was an exceptional loss item of about 37 crore rupees booked in the first half results. This was due to that warehouse fire back in Q1. They filed an insurance claim, so it's seen as a one-off, non-operational hit.
Got it. And what about their longer-term expansion plans? Are those still on track?
Seems so. They mentioned their retail store count is now over 1,600. And the tinting machine network, which is key for customized colors and distribution reach, has passed 6,500 machines installed.
They have a huge target for that, don't they? Like 10,000 plus by the end of FY26?
Ambitious, yes, but they say they're on track. And what enables all this continued investment is their balance sheet.
Still strong.
Very. Standalone net cash was around 636 crore rupees at the end of September. And that's after paying out a pretty hefty dividend of 443 crores during the quarter.
That cash cushion is key, isn't it? It means they can afford to keep up that expensive strategy, the high ad spending, the extra manpower in cities without financial stress.
Absolutely, it gives them the firepower. And briefly on the JVs, the automotive coatings one with Nippon Paint apparently saw robust growth thanks to the strong car market. Bolix in Poland had good sales growth, but profitability was a bit weaker due to pricing over there.
Okay, so summing up Q2, it feels like a story of weathering the storm, both literally and figuratively. BPIL basically accepted a margin hit.
A significant one, nearly 4 percentage points on the operating margin.
Accepted that hit to keep investing in A&P and manpower, particularly in those urban markets, even when the rain meant they wouldn't see immediate results. They prioritized defense and long-term positioning over short-term profit.
Exactly. Which leads us to the final provocative thought for you to consider. They've deliberately kept these operating costs high, that 20+% jump in A&P, the sustained spending on urban teams. Now, if the weather stays good, and if that pent-up demand really kicks in strongly,
Will the positive operating leverage, that scale effect, be strong enough to completely offset those higher ongoing costs?
that's the question. Management is guiding back to the 15–17% margin range. But could strong volume and value growth actually generate enough leverage to push them past that range in the coming year, maybe hitting a new level of operating efficiency in FY27? Or will those higher costs act as a ceiling?
Something to definitely watch in the next few quarters. The cost base is set. Now they need the revenue surge to make it pay off big time. A fascinating situation.
Indeed it is.
Well, that brings us to the end of this deep dive on Berger Paints India's Q2. Thanks for joining us.